The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. The latest Fitch Global Economic Outlook highlights a cautiously optimistic revision in global growth forecasts for 2025 and 2026. Now, the world economy, though, still faces considerable headwinds from tariff-induced uncertainties, slowing domestic demand in key markets like the U.S., and inflationary pressures exacerbated by volatile oil prices. Meanwhile, central banks are navigating a complex landscape of persistent inflation, slowing labor force growth, and diverging monetary policies across regions. These factors together create a challenging environment for businesses and investors alike, raising critical questions about the sustainability of growth and the risks ahead. So to find out more, joining me now is Charles Seville, who is the Senior Director in Fitch Ratings of the Economics team there. Charles, welcome to the show.
Hi, thanks for having me.
Thank you so much for joining us. Well, Charles, how significant is the impact of the U.S.-China trade tensions on global growth forecasts?
Well, pretty significant. When we started modeling the tariff impacts, we realized that tariffs were going to be much more of a factor in 2025. The modeling was telling us that tariffs were going to lower trade and increase prices and have a pretty big growth impact. So we estimated that impact on growth at being about a percentage point off growth in the US in 2025. And the Eurozone and China were going to suffer a similar size shock. It would just be over a slightly longer time frame. So tariffs are very significant for the global growth outlook. I think it is fair to say that these are taking slightly longer to show up than we expected. So last month, we forecast that global growth would reach 2.2%. If you go back to December, we were expecting 2.6% growth. So that is a sort of downgrade to the outlook, if you like. And as regards US-China tensions, I mean, these are two giant economies. The spillovers for the rest of the world are very significant. So taking into account the sort of easing of tensions that we saw between April and June, we did upgrade growth forecasts for the rest of the world.
Okay. Well, the report noted an upward revision in global GDP growth forecasts due to easing U.S.-China trade tensions. But with trade tensions now, the conditions now, is there now a downward revision?
Well, we haven't made a further downward revisions. Obviously, been a lot of news flow since the end of last month. I suppose what the data are telling us is that China is performing pretty strongly. We did get a dip in exports to the US, but the export engine is still working very well. The US is performing slightly, well, probably in line with our expectations. We haven't got Q2 growth for the US yet, but it will show it getting sort of back on track, I think. US and China are in a truce at the moment. So we've got this climb down from the extremely high tariffs, but that sort of theoretically comes to an end in mid-August or beginning of August, unless there's a new deal reached. But, it seems like the signals are relatively positive on that deal being reached. So our assumption is that the US's effective tariff rate on China is 41%. That's pretty much where it is now. So, yeah, we're sort of, I suppose, still constructive on US-China, but obviously 41% is a very high tariff.
Well, zooming into the U.S. here, what are the main drivers behind the U.S. domestic demand slowdown expected in the second half of 2025? And how might this affect consumer-driven sectors?
Well, probably on the face of it, the labour market is still looking quite supportive of consumption because the unemployment rate is just over 4%. It's in a similar range over the last 12 months. But you can see that the pace of job creation has slowed down, particularly private sector job creation, which is really the most telling signal. And it looks like we will get some squeeze on real incomes. So real incomes grew sort of faster than we expected, and that has enabled the consumer boom to sort of continue for longer in the US. But now we see wage growth falling and inflation is going to rise. So that really points to an outlook for slower consumption. And we've already seen some of that in the last couple of months of the US personal consumption expenditure data, where we are seeing personal consumption slow down. So if you look at our forecast, it's saying that real consumption, household consumption, is going to grow by 2% in 2025, and that's slowing down from 2.8% last year.
Well, China has been, using fiscal easing to counter the tariff shocks, while a weakening effective exchange rate could boost exporters' competitiveness amid falling local currency export prices. Charles, how effective is China's fiscal easing in offsetting the negative impact of U.S. tariffs, and what risks remain for Chinese exporters in such a volatile global environment?
Well, I think for sure there are still risks to China from tariffs. But so far, like I said, the data has been quite strong. I think government consumption will make a more significant growth contribution in 2025 than it did in 2024. Our measure of China's fiscal deficit, my colleagues over on the sovereign rating side, they're looking for that deficit to widen to 8% of GDP from 6% last year. So for sure there is fiscal easing going on. There's government spending going towards infrastructure and also incentives for consumption, which are certainly making a difference. So, yeah, I would stress that, there are still risks out there from the tariffs to China's export.
Okay. And the U.S. effective tariff rate remains elevated and is expected to rise slightly, impacting business confidence and contributing to upstream price pressures without yet affecting consumer inflation directly. But given the elevated U.S. effective tariff rate and its expected slight increase, what are the potential long-term implications for U.S. supply chains and inflation dynamics?
Well, I think we're in the early stages of gauging the impact. See, only a small share of the US consumer basket is imported goods, but we would expect the tariffs eventually to be passed on into inflation. So sort of lower supply, we're going to get a fall in imports, a rise in prices. So far, US imports have actually increased. I think that really speaks to the fact we're in this sort of prolonged phase of uncertainty about where tariffs are going to settle. Part of the response of businesses to that uncertainty has been to front-run imports and try and get as much product into the country before tariffs go up further. I think on supply chains, yes, one aim is to bring more of the supply chain back to the US. I think that will take time. And in terms of inflation, we see the tariffs adding 1% to US inflation so that they would be a bit under 4% by the end of year. So that's 1 percentage point higher than June. And that's really being driven by goods price rises. I think the big argument is whether that becomes a more, an inflationary process or whether it's a one-off price level adjustment.
Okay. I mean, oil prices have also been, volatile recently, prompting Fitch to raise its 2025 average oil price forecast, which could add to inflationary pressures globally. How might recent oil price volatility then shape inflation expectations and central bank policy decisions globally, especially in developed economies, Charles?
Well, we did raise our average oil price forecast in June by $5 to $70, but actually the rise in the oil price, given the tensions that the actual shooting that we saw in the Middle East was really remarkably muted. It's unwound. So if you look at oil prices, they're now lower than they were a year ago, actually helping to bring inflation down. And central banks are going to be usually look through commodity price shocks. It's not quite as simple as that because they do have to take expectations into account, and expectations are actually sensitive to the oil price. So it does matter to some extent, but I just don't see energy prices as being a major driver of inflation over the next 1 or 2 years. That could change if, given the US 50-day ultimatum to Russia, if that ended up taking Russian oil off the market, that obviously would change the picture, but that's not our core scenario.
But with all of this, how might, rising inflation risks driven by tariffs and oil price volatility affect investors' appetite for inflation-protected, assets or commodities?
Well, I'd say formally inflation-protected instruments are a pretty small share of US issuance. If you look at net issuance of TIPS, inflation-protected treasuries was just 2% in the first half of the fiscal year. Obviously, does seem to be growing interest in alternative assets among investors. That might be to do with the inflation protection that they offer, but I don't see this as a major trend in terms of seeking protection from inflation.
Well, in terms of diverging monetary policies as well, the Federal Reserve is expected to be cautious with rate cuts due to inflation and labor market concerns, while ECB appears more, comfortable cutting rates further, highlighting regional monetary policy divergence. So how should investors then interpret the contrasting monetary policy stances between the Federal Reserve and the ECB in the context of global growth and inflation?
Well, we think the ECB is close to the end of the rate cutting cycle. It's going to lower rates one more time to 1.75% in September. They might end up doing more if there's a bad tariff outcome. But basically, inflation in the Eurozone is at target. The composition could be better. It's still got quite high services inflation. But you've got wage growth cooling. ECB itself expects inflation below the target next year. The Fed, I think, as you rightly say, has been cautious, been on hold since December with rates at 4.5%. But we see it cutting once more in 25 and twice more in 3 cuts in 2026. Very interesting to see the Chris Waller speech recently. He was talking about the labour market slowing, but I'd say that inflation is still above target. So 2.7%, but maybe starting to see some weakening in the labour market. And even Powell has said, I think there might be space to lower rates a little bit. But I think, they have been waiting for the tariff picture to become clearer before doing anything. But yeah, I think very interesting reading that Christopher Waller speech. He was arguing that this is the right time for a rate cut. Rates should be closer to neutral, around 3%, basically because the labour market is weakening.
All right. And before we let you go here, Charles, anything else in the Fitch report you'd like to highlight as well?
Well, I think we shouldn't expect any fireworks from growth in Europe. We're looking at growth of just under 1%, and that, again, is a risk from higher tariffs. There's now a threat of 30% tariffs starting in August, and I think our forecast is that the effective tariff rate is closer to 15. So if that did come through, it would obviously be very much a downside risk. But so far, we're seeing sort of limited consequences for growth. And probably the big news in Europe is that the new German government's decision to increase spending is going to push German growth up above 1% in 2026. And that's going to be helpful for Europe as well.
All right. Well, some great insights from you there. Thank you so much, Charles, for joining me today.
Not at all. Anytime.
Thank you. That was Charles Seville, Senior Director in Fitch Ratings Economics team. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.